Okay, now the last few steps, they tend to all get condensed into sort of one page. So the last few steps are estimated continuing value, right? Then compute the cost of capital, then take the present value of all your cash flows to estimate enterprise value and equity value. And then we calculate and interpret our results, okay? So I've skipped some steps. First is I did the forecasts and I forecasted the free cash flows. Again, we'll do that in a later example, so I'm not going to do that here. But you saw what we need to do, right? The only thing that we didn't do was do the forecasts themselves. All the other steps would be the same. We'd just be dragging formulas. All right, so I forecasted 10 years here out to 2023. Whoops. What we need now is the continuing value. We can't forecast forever, and we know that, right? This is a lot of work to make all these forecasts. We can't keep going forever, and even if we could, we know that our forecasts about the future would just be even more wrong the farther we got. So ultimately, we have to call a stop to that process, and we calculate our terminal free cash flow, which is the continuing value. And the continuing value is based on the free cash flow. It's based on the key value driver formula, which you guys have already practiced calculating in your homework. The key value driver formula is NOPLAT in the last year, right? Times 1 minus the growth rate divided by the return on invested capital. All of that divided by WACC minus G. Okay, so we need that. The final year free cash flow, what we would do is we would forecast free cash flow out into 2024. And so we would be using 2024's free cash flow here, so 9,700. Again, we didn't do any of that. 1 minus the growth rate, which we also haven't done, 0.03. So we'll talk about that in the following chapter. Divided by WACC, which we haven't done, and we'll talk about more again. So there's a lot here that we're going to need to talk about later. And then that is, this is return on invested capital, which we did do, 0.08, 0.03. There we go. Okay, so NOPLAT in 2024, the next year's NOPLAT, times 1 minus the growth rate in revenue, we'll talk about that in the next chapter, divided by RONIC, return on new invested capital. We'll also talk about how to determine this because this is different than what we've been calculating, which is ROIC, which is the return on existing capital. All of that divided by the weighted average cost of capital divided by the growth rate in revenue. So WACC, we also will talk about how to calculate. So again, I'm leaving a lot of these details for future chapters. But what you should notice and what we should expect is that the continuing value is the biggest of our free cash flows. And that's because the continuing value is represents the free cash flows from 2024 to infinity. So of course it's going to be huge. We have taken the present value of an infinite number of future cash flows and condensed them down into one value. Okay. And then what we need to do is take the present value of those free cash flows. Right? We can use the present value formula, or we can use the Excel's pre-built present value formula. The rate that we're going to use is the discount rate. Right? And the discount rate is WACC. So that's the discount rate we're going to use. The number of periods is the number of periods in the future from the year that we're starting our analysis, which in this example would be 2013. Right? So 2014 is 1 year in the future. One of the other ways that you can do this is to put, say, put a 2013 measure up here, And then in our formula, we can do this. PV, we can do 0.08. We can do, as our number of periods, we can do this minus this. And we can fix this. Then our payment is nothing. And our future value is this. Okay, cool. And then we can drag this. There we go. Okay. Now we have our present value of all our free cash flows. Notice that they're all negative because of the way that Excel calculates these things. So we will, to take the present value of all the free cash flows, we'll take the sum of all these, and then we'll multiply that by -1. And that is the present value of our free cash flows. So we call this the present value of all the future free cash flows. This is our predicted value. We're going to multiply this by an adjustment factor to get what we call the value of operations. Now, this mid-year adjustment factor, it's not something you have to worry about. It has to do with the fact that we assume that UPS's cash flows do not occur evenly throughout the year. And because of when they report their cash flows, we want to adjust those cash flows so that they are more accurately representing the present value. It's not hugely important, and we will go to a little more detail about it later. But this is the value of the firm's operations. Okay, so that's what we have done throughout this whole process so far is value the firm's operations. That is not the entire value of the firm, because there are some assets that were not considered operational assets, and because they weren't considered operational assets, we didn't include them in our value. So the total enterprise value of the firm includes also any non-operational assets. So anything on the balance sheet that we did not include, an asset on the balance sheet that we did not include in our original reorganization. So that would be excess cash here. We are still going to ignore income taxes for now. We will talk about them later, and it will be investments, right? The rest of them are financing or income tax assets that we will talk about later. So we need to add the value of excess cash and the value of the firm's investments. Okay, so excess cash, again, we'll talk about how to calculate what is excess and what is operating cash in a later chapter. The value of the firm's investments is taken straight from the balance sheet here, 148 in 2013. Enterprise value is then the sum of these three items, right? And that's the enterprise value of the firm. So this is step 5. We have calculated the enterprise value of the firm. This is the total value. This is what UPS is worth: $121,993,000,000 based on the value of its operations, all of its operations, plus the value of any non-operating assets that it has. Okay. Now, to calculate equity value, what we need to do is subtract the value of any of its obligations. So any of these financing items that we ignored from the balance sheet. So, for instance, the value of the firm's debt. So, for instance, the value of the firm's debt, value of the firm's debt. So we come back here to the balance sheet. The firm has debt from two sources. It has short-term debt in 2013. It has long-term debt in 2013. We want that to represent a claim against the firm. The value of the firm's unfunded retirement obligations. Value of its unfunded retirement obligations. Again, this is something that we will sort of spend a little more time talking about in the future. This is money that the firm owes to its retirement plan It has, for instance, promised to match a 401k contribution for its employees, things like that. This can be a pretty significant liability that the firm owes here for UPS. It's almost $5 billion. So it's pretty significant. It's something that the value of its capitalized operating leases. This is remember that a lease is a rental payment. So this is simply just like what we it's just like a loan. We owe this money to the people that we are leasing the aircraft or whatever other asset we are using, and so we've got to treat it like a loan. And then the value of any non-controlling interest. This is a claim that someone else has on the firm that we owe. This is an obligation that we have, and so we need to subtract it. Then equity value is the value of the firm's operations less any claims against the firm. And so we get about $100 billion. And then equity value per share is simply equity value divided by the number of shares outstanding. And in 2013, UPS had $923 million in shares outstanding for an equity value per share of $109. And this is it. This is the sort of end goal of any DCF model. Now, step 6 would be to go back and talk about how our assumptions make sense, how they fit together, whether there's any problematic assumptions that we've made. But ultimately, this is where we're headed. We'll spend more time talking about all the details, all the points where I said, okay, we don't know how to do this yet, we haven't talked about this yet. We'll spend more time talking about number 6, step 6, which is how do we interpret this? How do we judge all of these decisions? And of course, this is a simplified version of what's going on, right? It's just a demonstration version of what's going on. A more complicated version would include all of the historical years. It would also include all of the forecasts. And it would break it down into an even finer thing. So, for instance, here's like the actual valuation model that I have built up that you might use instead, right? So it has a lot of this stuff just pre-built in. And we'll talk about some of this in the later thing. But, for instance, here's the historical income statement. So you would fill out the income statement. A lot of this stuff would be pre-calculated so that you can just spend your time entering in the values, right? With a statement of changes in equity. Here's the balance sheet information. Here's any off-balance sheet stuff that we might want to put in. So here's our 10 years of historical data from 2013 to 2022, right? Then this is where all the forecasts would happen. Again, the forecasts are built in. So this sheet would pull from the historical data what I had entered in. It would calculate the forecasts automatically and then present to me forecasts going forward into the future, right? And it would do that for all the items on all the operating items from the balance sheet and the income statement. These would be all the explicit forecasts. Right, so these are the forecasts, say 5 years, where I'm forecasting literally every item on the balance sheet and the income statement. And then here's where I'd calculate WACC. And then after about 5 years, I would only forecast the sort of key value drivers. So in the second stage, I'd be forecasting what we call the key driver forecast. So I'd only be forecasting things like revenue growth and EBITDA, NOPLAT, net PP&E, just like the big bolded items, just the stuff that really matters for the firm. And so then I'd forecast it out for another 10 years until my continuing value year, right? So this would be a 15-year forecast out into 2023. Then I'd have my results here. So I'd have my historical balance sheet information. I'd have my detailed forecast. I'd have my key value driver forecast. So this would be the result of all my forecasts and all my inputs that would be displayed here. These would have checksums and stuff so that they would make sure that everything was being input correctly, that the balance sheet balanced, that everything worked out smoothly, and then the valuation would update automatically. All this stuff would just happen, right? The present value is already built into this stuff. It would look at, we would calculate my WACC, it would input everything, it would give me the valuation based on a DCF approach, based on an economic profit approach. It would give you the value of the equity and the value per share. All of that would be automatic. And the nice part about a model like this versus one that I just sort of did ad hoc, like what I showed you, and even one that I showed you here, if we've done it correctly, right, because I've tried to tie everything back to the previous inputs. If I was like, if 2013 had a restatement and this was, say, 60 billion instead of 58 billion, what we would hope is that everything down the line would update, and we would update all the way down here. Now, clearly, I didn't do a good enough job of linking all these things together because I was copying values back and forth. But the goal in a model like this is that we should be able to input a new year and input any updates, and we should, because it's all linked together so successfully, that this should update automatically. And that way I can come in and say, okay, what if the firm is releasing a new product, and so we're going to change our forecast for revenue. The new product is going to generate additional revenue growth, so we're going to change our forecast here. And what happens if that forecast changes? How's that going to change valuation? Right? We would like for this to be a very dynamically updated process so that all of this stuff just, we can play around with the numbers and see what it looks like once we're finished. Okay. So this is a more, I would say, professional one. Obviously, you can see it would take a lot more work to fill this kind of thing out, which is why we're already at 2 hours here. I didn't want to go any farther. We can talk about, if you guys think that would be valuable, I can think about making a more significant video where we sort of fill out one of these. But this should match up with the slides for Chapter 8. So hopefully this gives you a good idea of what this class is about, what valuation is about, what a DCF model looks like, and where we're headed. Okay, because where we're headed is mostly to talk about all the details that we didn't have. That we didn't know what to do about in the model that we just sort of worked through. Okay. That's it for Chapter 8, and that's it for this. So your exam's coming up, and I'll send some more information out about all that. But good luck.